Today, we're plunging into the fascinating world of Allegiant Travel Company, ticker symbol ALGT.
Hmm.
Now, when you hear airline, you usually think, okay, a company that gets you from point A to point B. Pretty standard stuff.
Sure.
But imagine an airline that not only flies you across the country, but also decided to build and run a massive resort.
Yeah, that definitely wasn't in the standard airline playbook.
Exactly. Allegiant has truly thrown some curveballs, making headlines not just for their flight routes, but for some, well, truly unexpected strategic and financial twists.
That's right. Our mission today is to take a deep, comprehensive, and objective look under the hood of Allegiant. We're going to dissect their financial statements, analyze their stock performance, track some pretty intriguing insider moves,
Oh, yeah.
and even explore their government lobbying efforts. Our goal is really to extract the most important nuggets of knowledge for you, giving you a shortcut to being truly well-informed about this unique enterprise.
And hopefully have a little fun along the way.
Hopefully, yeah. With some surprising facts and maybe just enough humor to keep you hooked.
Absolutely.
A good place to start is probably Allegiant's core identity, which, as you hinted, is quite distinct from your typical airline operator.
You know, for the longest time, I just pictured Allegiant as another low-cost carrier, maybe like a smaller version of Spirit or Frontier. You know,
That's a common perception.
but the sources reveal something much more expansive. They explicitly identify as a leisure travel company.
That's the key phrase right there, leisure travel.
Yeah. Their entire business model isn't about connecting, say, New York to LA, the big hubs. Instead, their strategy is laser-focused on providing air services to residents of what they call underserved cities across the U.S.
Right. Think smaller regional airports, places the legacy carriers might fly over rather than put in.
Exactly. Connecting those communities directly to popular vacation hotspots, think Orlando, Las Vegas, Florida beaches, often without needing connecting flights through massive congested airports. It's a very specific niche play in the airline market.
And this niche strategy directly influences their operational model. It's quite interesting. They operate what they describe as a low-cost, low-utilization passenger airline.
Low utilization, what does that mean exactly? Less flying time per plane.
Precisely. It's not just jargon. Low utilization means their planes aren't necessarily flying from dawn till dusk every single day, back-to-back routes like some major carriers.
Yeah.
This approach lets them keep costs down. They minimize idle time in expensive major airports. They can optimize maintenance schedules, manage their fleet more efficiently, perhaps.
So fewer flights, but maybe more targeted.
Exactly. Targeting specific leisure markets, often with fewer flights per aircraft per day. Now, that reduces overhead, but it also presents its own challenge in maximizing, how much work you get out of each very expensive asset.
Makes sense. And they sell tickets, obviously, but also bundled stuff.
Right. They sell air transportation standalone, which is straightforward, but crucially also bundled with other air-related and third-party services and products.
Like hotels, rental cars.
Could be anything. Rental cars, hotel stays, maybe even theme park tickets, creating a kind of one-stop shop for vacationers heading to those leisure destinations.
That's smart. Capture more of the travel spend.
Definitely. And there's another layer to their revenue. They also provide air transportation under fixed-fee flight arrangements. So they might operate flights for other entities, like maybe sports teams or tour operators, for a set price.
Ah, like charter arrangements?
Sort of, yeah. It provides a predictable income stream outside of the volatility of regular ticket sales.
Okay, here's where the story of Allegiant truly gets fascinating and maybe a bit unexpected. Historically, they've operated with what they presented as two main segments.
Right.
There's the airline, which has, undeniably been their main revenue generator since day one.
The core business.
And then the Sunseeker Resort.
Ah, yes, the resort.
I mean, the Sunseeker Resort Charlotte Harbor sounds like something out of a fancy travel brochure. A sprawling destination, hotel rooms, luxurious suites, extensive meeting facilities, loads of food and beverage options.
And even its own golf course. The Aileron Golf Course.
A golf course. It was, without a doubt, a significant and really ambitious diversification play, venturing far beyond just planes and runways.
It was certainly an audacious undertaking, a move that definitely raised eyebrows across the industry. I mean, an airline building a resort.
It's pretty unusual.
Very. And what's truly striking here, and frankly feels a bit like a strategic admission in hindsight, is the stark reality revealed in recent news. One source bluntly stated, and I quote directly here, "An airline built a hotel. It crashed and burned."
Oof. Crashed and burned, that's blunt.
It's pretty strong, yeah. It highlights the significant challenges, maybe the unexpected difficulties they faced, trying to integrate a full-service hospitality business into an airline's operational model. Different beasts entirely.
Completely different skill sets needed, I imagine.
Absolutely. And the sources then reveal this major, almost seismic strategic shift. Allegiant Travel Company sold the Sunseeker Resort, Charlotte Harbor.
Sold it? To who? And for how much?
They sold it to Blackstone Real Estate for a reported $200 million in July 2025.
Wow. $200 million. That's not just pocket change. It's a monumental divestment.
It really is.
And it immediately raises a huge question for you, the listener. What does this mean for the company's future focus? Are they now solely an airline, explicitly doubling down on their core competency in the skies?
Or are they maybe willing to pursue other leisure-related ventures down the line? Just maybe not something involving owning massive amounts of real estate and running a hotel directly.
Right. This feels less like just shedding an unprofitable asset, although maybe it was, and more like a definitive moment of reevaluation for their entire business strategy. It's almost a strategic declaration. Okay, maybe resorts aren't our thing.
Precisely. This sale isn't just a financial transaction. It's a stark admission, really, that Allegiant's core competencies lie in the skies, not necessarily in large-scale hospitality management.
So refocusing.
Exactly. This pivot could free up substantial capital and, maybe just as importantly, management focus, allowing them to truly concentrate on optimizing their airline operations.
Which, as we'll see, might need some optimizing.
Well, yes, but it also reflects the profound difficulty and indeed the capital drain of integrating such a different business. For investors, this begs the question, does this make them a leaner, more focused airline, maybe finally capable of converting that growth into consistent profit?
Or does it signal a lack of internal capability for successful diversification? Could that limit future growth avenues outside of just flying planes?
It's a calculated risk, isn't it? Emphasizing focus, maybe at the cost of constraining long-term expansion possibilities beyond air travel?
Right. So with that dramatic strategic pivot in mind, let's now peel back the layers and decipher Allegiant's current financial snapshot, because it's truly a tale of mixed signals. Creates quite a complex picture.
It certainly does.
As of August 15th, their last close price was $59.78, with a small daily dip of about $0.12, so pretty flat that day. Their market capitalization, the total value of their outstanding shares, stands at a solid $1.10 billion.
Okay, $1.1 billion market cap. But what's absolutely crucial to note alongside that, and this is where the financial puzzle gets really interesting, is their enterprise value.
Which is?
Which clocks in at a hefty $2.27 billion.
Whoa! Wait, $2.27 billion. That's more than double the market cap.
Exactly. That huge disparity points directly to Allegiant carrying a substantial amount of debt. Or, more accurately perhaps, obligations.
Obligations? Like what? Beyond just standard debt?
Well, for an airline, it's often more complex than just bonds or bank loans. This figure likely includes significant operating lease liabilities for their aircraft fleet.
Ah, so the planes they lease rather than own.
Right. Unlike owned assets, these leases don't always fully reflect as traditional debt on the balance sheet in the same way, but they are massive long-term financial commitments.
They still have to pay for them every month.
Absolutely. They demand a significant portion of their operational cash flow just to service these ongoing lease payments. So while their asset base might appear smaller based purely on market cap, their overall financial obligations are much, much larger. It's common in the industry, but crucial to understand.
That distinction with operating leases is incredibly important for understanding the true financial leverage they're working with. It's not just the $1.1 billion company the market cap suggests.
Not at all. The enterprise value gives a much fuller picture of the total claims on the business.
And speaking of operations, their workforce is quite large, too, for an airline their size. Sources cite either 6,400 or maybe closer to 5,980 employees, depending on the platform you look at.
Still a significant number of people.
Definitely. Now, let's get to the profitability, or maybe the glaring lack thereof.
Yeah, this is where things look challenging.
We're seeing a lot of red ink here, a significant amount. Their income for the trailing 12 months TTM is a staggering negative $286.92 million.
Negative $286 million. That's quite a loss, a very deep hole.
It is. And this substantial loss is directly reflected in their earnings per share, or EPS. That's negative $15.94 per share.
Right, which in turn results in a negative price-to-earnings PE ratio. That's why you often see it displayed as just a dash or NA on financial sites. Simply means the company is currently unprofitable.
Can't have a PV if the E is negative.
Exactly. And their profit margin tells the same story, negative 11.13%.
Yeah.
Also deeply in the red. It means for every dollar of sales they generate, they're actually losing about 11 cents once all expenses are factored in.
Losing money on every sale, that's
Yeah.
not sustainable long term.
It's certainly not. It's a critical metric because it tells us their core business, as it stands today with all its costs, isn't financially self-sufficient.
Yikes. And the picture doesn't get any rosier when you look at other key efficiency metrics, does it?
Unfortunately, no. Their return on assets, ROA, is negative 6.18%. They're losing money on the assets they deploy.
Okay.
Return on equity, ROE, is even worse, a dismal negative 24.02%, basically indicating they're destroying shareholder value at the moment.
Ouch.
And return on invested capital, ROIC, is negative 9.92%, shows their investments, their capital, aren't generating sufficient returns to cover their cost. All these negative returns really highlight the current significant challenges they face in generating profit from their assets and investments.
It's not just a small stumble, it sounds like. It's a systemic hurdle in converting their operations into positive financial outcomes right now.
That's a fair assessment based on these trailing numbers. However, there's a glimmer of light, perhaps, or at least a nuance if we look at their gross margin and operating margin.
What do those show?
Well, their gross margin is actually positive 10.90%, and their operating margin is also positive at 6.22%.
Positive. How does that work with the massive net loss?
It's a classic telltale sign in financial analysis. It suggests their core airline business can make money just from selling tickets and those ancillary services before you consider broader corporate overhead and, crucially, financing costs.
So the actual flying part might be profitable. The cost of getting a passenger from A to B is covered.
It appears so on an operating level. But as you noted, that positive operating profit is quickly eaten up by other expenses, primarily that substantial interest expense on their debt and leases.
And maybe lingering costs from the resort fiasco, write-downs.
That's also quite possible, yes. Write-downs related to the Sunseeker sale could definitely impact the net income figure. So it might not necessarily be a fundamental problem with their flights themselves, but rather with their overall financial structure and perhaps the strategic bets they've made in the past, like the resort.
Okay, that makes more sense. The core operation might be okay, but the overall company structure is weighing it down.
That seems to be the picture these numbers paint.
So on one hand, they're battling these significant losses, but on the other, their revenue performance tells a surprisingly different, much more optimistic story. They've clearly been a growth engine on the top line.
Yes, that's the paradox here.
Their sales for the trailing 12 months are substantial, $2.58 billion.
Nearly $2.6 billion in revenue. That's not small.
Not at all. And historically, their sales growth has been quite robust. An impressive 13.73% average annual growth over the past 3 years.
13% growth is strong.
And a solid 6.42% over the past 5 years. This clearly demonstrates the company has been consistently expanding its top-line revenue. It shows there's fundamental demand for their services.
And even more recently, that growth continues. Sales year over year on a trailing 12-month basis are up 3.17%.
Okay, still growing.
And sales quarter over quarter are up 3.47%. So what does this all mean for you, the listener, trying to piece this puzzle together?
Yeah, what's the takeaway?
Allegiant is successfully growing its sales, expanding its customer reach. There's clear market demand for its niche leisure travel offering. However, it's clearly struggling significantly with profitability.
It's like that machine analogy you used earlier. It's getting bigger, acquiring more customers, doing more work.
But it isn't yet efficient at converting that increased activity and growth into actual sustainable profit.
Right. Filling more seats, but the total cost, planes, fuel, maintenance, operations, and especially servicing that substantial debt is eating into everything.
It creates a significant paradox in their financial narrative, one that investors are watching very, very closely.
Okay, let's delve deeper into that financial structure then. Specifically, the debt and liquidity. You mentioned the high enterprise value. What about specific debt ratios?
Their debt-to-equity ratio is 1.93.
Okay, nearly 2 to 1.
And long-term debt-to-equity is 1.74. These are relatively high numbers, certainly compared to many other industries.
But you said that's somewhat typical for airlines.
High, yes, but again, it's a characteristic we frequently see. Acquiring new aircraft, maintaining the fleet, covering extensive operational costs. These are incredibly capital-intensive endeavors. Airlines inherently rely heavily on debt and lease financing to fund these colossal expenses.
So high debt is maybe less alarming here than it would be in, say, a software company.
Potentially, yes, you expect it.
Yeah.
What's perhaps more indicative of their immediate financial health, their ability to meet short-term obligations, are their liquidity ratios.
Like the current ratio.
Right, the quick ratio stands at 1.07 and the current ratio at 1.10.
Okay, just over one. What does that tell us?
These ratios suggest that Allegiant has just enough current assets, things like cash, receivables, to cover its short-term liabilities, those due within a year.
So they can pay their immediate bills, but there's not a lot of wiggle room.
Exactly. It indicates a somewhat tight liquidity position, certainly not a vast cushion, but it doesn't signal an immediate crisis or inability to pay suppliers or employees right now. It's a delicate balance.
They also have a decent cash reserve per share, $46.91 according to the data. That provides some buffer against unexpected short-term shocks, right? Like a spike in fuel prices.
Yes, having that cash on hand per share is a positive. It provides some breathing room, which is always important in a volatile industry like airlines.
Okay. Now, since their PE ratio is negative because they're unprofitable, analysts often pivot to other valuation metrics to gauge potential value.
Right, you need other tools.
Their price to sales, PS, is 0.43, and price to book, PB, is 1.04. How should we interpret those? They seem low.
They are relatively low. For an audience maybe used to valuing tech stocks on high PE multiples, these might seem like a steal. But for a capital-intensive, high-debt industry like airlines, PS and PB can offer a more stable comparison point over time, or against peers.
So it signals the market is valuing their revenue stream or their asset base relatively modestly, even if current profitability isn't there.
Exactly. Especially if you believe a turnaround in profitability is possible. A low PS suggests the market isn't paying a huge premium for each dollar of sales currently. Same for PB. It's valuing the company at roughly the accounting value of its assets minus liabilities.
Okay. What about other metrics? Price to cash, free cash flow.
Other valuation metrics add more layers. Price to cash, PC, is 1.27. Price to free cash flow, PFCF, is 11.91.
11.91 PFCF. That doesn't sound too bad, actually. Suggests they are generating some free cash flow.
It does suggest positive free cash flow on a trailing basis, which is cash left over after operational expenses and capital expenditures. That's a positive sign amid the net losses. Then you have enterprise value ratios, EV/EBITDA at 5.39 and EV sales at 0.88.
EV sales under 1, again, seems lowish.
It reinforces that idea that the total enterprise isn't valued at a high multiple of its sales. But here's where it gets really interesting and perhaps counterintuitive, given all the red ink we've been discussing.
Go on.
Despite these current losses and negative profitability metrics, the forward PE is 10.09.
Forward PE of 10. How? They're losing money now.
Because analysts are projecting a massive turnaround. They're forecasting an EPS next year of positive $5.92.
From negative $15.94 now to positive $5.92 next year. That's a huge swing.
It's enormous, and they project an incredibly impressive EPS growth rate of nearly 50%, 49.58% annually over the next 5 years.
Wow. Okay.
This strongly implies that the market, or at least the analyst community consensus, is expecting a significant, dramatic rebound in earnings for Allegiant. They're betting heavily on a turnaround.
Betting that selling the resort, focusing on the airline, cutting costs, or maybe just better market conditions will fix the profitability problem.
All of the above, likely. It's a very forward-looking perspective, placing a lot of faith in future execution despite the current challenges.
That's quite the leap of faith, or maybe, like you said, a deeply informed expectation. It leads us perfectly into their stock performance, which has truly been, well, a turbulent flight path is putting it mildly.
Turbulent is a good word for it.
If you look at just the short-term momentum, things appear remarkably good, almost suspiciously good given the losses.
Right.
The stock has seen strong gains recently. It's up 22.15% in just the past week.
Huge weekly gain.
Up a solid 14.3% in the past month and 8.18% in the past quarter. And zooming out just a bit, over the past year, it's actually up a very impressive 60.70%.
60% in a year. That looks great on a chart.
It indicates a significant recovery from recent lows, doesn't it? Makes it look quite attractive at first glance, especially if you're maybe a short-term trader looking for momentum.
Definitely catches the eye. However,
Yeah.
if we pull back and zoom out to the long-term picture,
Yeah.
the narrative becomes far less rosy. Frankly, it's quite concerning for anyone who's been a long-term holder.
How bad is it?
The stock is down 26.70% over just the past half year, down 36.49% year to date.
Okay, so that recent rally hasn't erased the year's losses.
Not even close. And the decline becomes even more pronounced, entering truly staggering territory when we look at multi-year periods. It's down a precipitous 44.25% over 3 years.
Wow.
Nearly half its value gone in 5 years, with a 49.86% drop.
Half its value in 5 years.
Now, hold on to your hat for this one. A truly astonishing 72.57% decline over the past 10 years.
72% over a decade. That's brutal.
It's a dramatic, consistent drop over the long haul, a real wealth destroyer for long-term buy-and-hold investors over that period.
So how do you reconcile that? Is this recent bounce just, a dead cat bounce within a long downtrend? Or is it a genuine sign of that fundamental turnaround analysts are predicting, something long-term investors should actually trust this time?
That is the multi-billion-dollar question, isn't it?
It really is. The current price, around $59.78, is still 44.43% below its 52-week high of over 107.7.
Yeah, quite a gap.
Yet it's also 59.41% above its 52-week low of $37.50. This really paints a picture of extreme volatility. A stock that's trying desperately to find its footing after a steep, prolonged decline. It's certainly not for the faint of heart.
No, definitely not. It feels like navigating through a financial storm with both intense tailwinds pushing it up recently and massive headwinds holding it down long term.
And the volatility metrics back that up, right?
They absolutely do. The data shows weekly volatility at 7.23% and monthly at 5.57%. These indicate significant daily and weekly price swings are the norm here.
So big moves, up or down.
Yes. Moreover, the beta is 1.71.
Beta of 1.71. Remind us what that means.
Beta measures a stock's volatility in relation to the overall market, usually represented by the S&P 500, which has a beta of 1. A beta of 1.71 means Allegiant's stock price tends to be 71% more volatile than the broader market.
So if the market moves 1%, Allegiant tends to move 1.71%.
On average, yes. If the market moves up 1%, Allegiant tends to move up 1.71%. But crucially, the inverse is also true on the downside. If the market drops 1%, Allegiant tends to drop 1.71%.
Amplified moves.
Exactly. For investors seeking stability or a less rocky ride, this makes it a significantly higher risk investment. It's prone to exaggerated movements both up and down. It truly has had a turbulent flight path, as you described, and that turbulence seems set to continue.
Given that ongoing turbulence, let's look at who's betting where. Let's shift to the ownership structure, insider activity, and what the analysts are actually saying.
Good idea. Who owns the stock?
Starting with ownership, it's quite a mixed, almost contradictory signal, actually. Institutional ownership is incredibly high.
How high?
99.73%.
99.7%. So basically, institutions own almost the entire company.
Pretty much. Virtually all of Allegiant's shares are held by large investment funds, pension funds, mutual funds, other big institutions. This often suggests smart money has a significant stake and presumably belief in the company's long-term prospects, or at least its trading potential.
That's usually seen as a positive sign, having that institutional backing. But what about insiders, the people actually running the company?
Well, that's the juxtaposition. Despite that overwhelming institutional presence, insider ownership stands at a substantial 23.14%.
23%. That's actually quite high for a publicly traded company of this size, especially one dominated by institutions.
It is significant, yeah. It indicates that company executives and directors hold a notable personal stake. In theory, this should align their interests directly with the long-term success and profitability of the company. Skin in the game.
Right. What's fascinating here is precisely that juxtaposition you mentioned. Nearly all shares are technically held by these vast, often impersonal institutions, yet the insiders, the people who truly run the company day to day, still have a very material stake.
Creates a curious dynamic, doesn't it? Who truly controls the direction? Who benefits most? It's a balance worth watching.
Definitely.
Okay, so insiders own a good chunk. Now let's talk about insider trading, that perennial curiosity for investors trying to follow the money, or maybe see where the smart money isn't going.
Are they buying or selling?
Well, that's the thing. There's a distinct lack of insider buying. The data reveals a pretty consistent pattern of insider sales.
Oh, interesting. Who's been selling?
Directors and officers like Gary Elmer, Canny Frank Wilper, who was the COO until recently, Sandra Douglas Morgan, and especially Maurice J. Gallagher Jr., the executive chairman. They've all been actively selling shares recently, with transactions spanning from August 2024 right through August 2025.
So a pattern over the last year or so from multiple executives. And Gallagher, the chairman, his sales were large.
Particularly large, yes. The data shows in November 2024, he conducted some very significant sales, offloading tens of thousands of shares valued in the millions of dollars.
Wow, okay. Millions worth sold by the chairman. That raises an important question for you, the listener, to consider.
Which is?
While insider sales don't always signal a lack of confidence, I mean, people sell for lots of reasons. Personal financial planning, diversifying assets, maybe buying a house or paying for college.
Sure, it's not automatically a panic signal.
Exactly, but a consistent trend of significant sales from multiple high-level insiders, especially the chairman, that can be a crucial data point. Investors definitely need to consider it.
Especially when there aren't offsetting insider buys happening around the same time.
Precisely. It might suggest that those closest to the company, the ones with the most information, see more value in liquidating their holdings at current levels than holding onto the stock for future appreciation. Again, not proof of anything, but certainly a data point away.
A yellow flag, maybe, if not a red one.
The yellow flag is a good way to put it.
And it's not just corporate insiders selling. Thanks to public record transparency requirements, we've even seen members of the U.S. Congress trading ALGT stock.
Oh, really?
Josh Gottheimer, a Democrat from the House, and Gilbert Ray Cisneros Jr., also a Democrat from the House before he left office. Both have made transactions in Allegiant stock.
And were they buying or selling?
Their trades, which were largely in the smaller range, like $1,001 to $15,000, appear to be predominantly sales, mirroring that broader insider trend we just discussed.
Interesting. This simply highlights the transparency we get from public records,
Oh.
allowing us to observe how elected officials' portfolios intersect with specific companies.
Yeah, it's a data point for observation and public accountability. Not necessarily a judgment on the company itself, but just another insight into how various sophisticated investors, including lawmakers, are positioning themselves.
Right. A piece of the mosaic.
Exactly. So moving from insiders and politicians to the professional analysts, what's the sentiment there? Is it bullish, bearish?
It's genuinely divided. Almost a tug of war, really.
How so?
Well, the average analyst recommendation for ALGT is 2.62.
On what scale?
Usually a 1 to 5 scale, where 1 is strong buy and 5 is strong sell. So 2.62 typically falls into a hold or neutral category. Middle of the road.
Okay, so no strong conviction either way on average. What about price targets?
The consensus target price among analysts is $60.75.
$60.75, but the stock is trading around $59.78. That's basically right where it is.
Exactly. It suggests the average analyst expects quite limited upside from the current levels. They seem to believe the stock is more or less fairly valued right now, or maybe that future growth potential is already priced in after the recent run-up.
Not much expected gain, according to the average analyst. But are the ratings stable or are they changing?
Oh, they've been quite volatile, really reflecting the uncertainty surrounding Allegiance. It's been all over the map.
Like what? Upgrades, downgrades?
Both. There have been recent upgrades like Evercore ISI moving to outperform and Raymond James upgrading to strong buy, and price target increases from firms like TD Cowen and Raymond James. So, some positive moves.
Okay, some bulls out there.
But simultaneously, there have been downgrades from other significant firms. Deutsche Bank, Barclays, Susquehanna, Cowen again downgrading after an earlier upgrade maybe, often accompanied by price target decreases.
Wow. Whiplash.
Pretty much. And adding another layer of caution, UBS resumed coverage relatively recently, July 2025, with just a neutral rating. And notably, back in April 2025, UBS had downgraded airlines generally amid broader recession fears.
So specific company issues mixed with macro concerns.
Exactly. This clearly shows a significant lack of strong consensus among the professional analysts. It underscores the company's complex financial situation and the uncertain broader economic outlook for the airline industry as a whole. It's like analysts are on a seesaw with Allegiant, constantly trying to figure out which way it's going to tip.
That's a perfect way to put it, a seesaw of opinions. Which brings us perfectly to recent news and developments. These really showcase the company riding the waves of change, experiencing both significant headwinds and tailwinds.
Yeah, the news flow has been busy.
Operationally, there's been a very significant challenge reported, something any airline investor would flag immediately. August 2025 news reports indicate that Allegiant pilots Local 2118 are preparing for a vote of no confidence in management.
Oof. A vote of no confidence. That's never a good sign.
No. It's a pretty big red flag, isn't it? Indicates potentially deep-seated issues that could impact employee morale, maybe operational efficiency, even public perception if it escalates.
Absolutely.
Mhm.
Historically, such votes in the airline industry can signal serious labor disputes or a fundamental breakdown in trust between management and employees. That can lead to flight disruptions, contract negotiation battles, or even impact safety perceptions, rightly or wrongly. It's definitely something to watch.
For sure. But on the positive side, operationally speaking, Allegiant has received some significant external accolades recently.
Okay, some good news too.
Yes, they were named Best Low-Cost Airline in North America at the prestigious 2025 World Airline Awards.
That's a big one. Skytrax awards are well respected.
And they also topped USA Today's Reader's Choice Awards for Best Airline Credit Card and Best Frequent Flyer Program.
So passengers seem to like them, or at least their loyalty program and credit card.
Right. These are strong indicators of customer satisfaction and brand recognition. It proves that despite potential internal strife with pilots, they are clearly getting some things right from a passenger's perspective, which is crucial for their leisure-focused model.
Interesting dichotomy. Internal issues, external praise. There was also a change in chief operating officer reported back in March 2025, right?
Yes, that's right. Kenny Wilper, who was selling stock, left. Maybe that COO change was a strategic move in response to some of these operational shifts or part of a broader management restructuring.
Could be. New leadership often comes in during times of transition or challenge.
So a fascinating mix of internal strife and external accolades, like two sides of the same coin.
Definitely a complex picture.
They've also been incredibly active on the network expansion front, which speaks directly to that top-lane growth we discussed.
Adding more routes. Where to?
In August 2025, they announced 4 new routes, specifically to Atlantic City, New Jersey, and a total of 8 new cities added to their map, including places like Huntsville, Alabama. It's a significant expansion, reinforcing that underserved market strategy.
Makes sense. Play to their strengths. And Florida too, right? That's a key market for them.
Huge market. Yes, further aggressive expansion was announced in July 2025. 12 new routes, significantly expanding their Florida footprint, a key leisure destination. And even earlier, in May 2025, they announced 5 other new routes, all with their characteristic low one-way fares.
So they're definitely pushing growth through network expansion. Are the planes filling up?
It seems so. This aggressive network expansion is clearly reflected in their traffic numbers. The data shows March, April, May, and June 2025 all showed consistent year-over-year improvement in passenger traffic.
Okay, so growing customer base, increasing demand for their flights, that's essential for revenue generation in their volume-driven business model.
Absolutely. The question for investors, though, is whether this expansion comes with a proportional increase in profitability.
Right. Are they strategically entering markets that maximize their unique low-cost, low-utilization model?
Yeah.
Or are they perhaps chasing market share at the expense of healthy margins, maybe flying routes that are popular but costly to operate?
That's the critical paradox, isn't it? The top-line growth we talked about earlier is clearly fueled by this expansion, but is it profitable growth?
The billion-dollar question.
Now, regarding earnings performance itself and those analyst expectations, Allegiant reported strong Q1 2025 and Q2 2025 earnings, ostensibly topping both revenue and earnings estimates.
Topping estimate sounds good.
It does. Q1 earnings were reported as improved YY, and Q2 earnings surpassed estimates. On the surface, that sounds like fantastic news, suggesting a financial rebound is underway.
But I sense a but coming.
But here's that crucial distinction for you, the listener, again. Because the headlines can be deceiving. Despite beating analysts' expectations in Q2,
Yes.
their Q2 earnings actually declined year over year.
Ah, there it is. Better than expected, but worse than last year.
Exactly. It's an absolutely critical nuance. It means they performed better than what analysts predicted. Maybe expectations were just set really low. But their absolute performance was weaker compared to the same period in the prior year.
So the trend wasn't necessarily positive, even if they beat the forecast.
Right. Now, the earnings calls did highlight record passenger traffic and strong operational gains, pointing to their continued growth initiatives and maybe some efficiency efforts paying off operationally.
Management putting a positive spin on it.
Naturally. However, conflictingly, Zacks, a well-known financial analysis firm, issued strong sell recommendations for ALGT stock in both August and May 2025, right around the time the company was supposedly beating estimates.
Wow. Strong sell from Zacks, even with earnings beats. That starkly highlights the ongoing divergence in opinion on the stock's future. Some see improvement, Others see fundamental weakness.
Exactly. What's interesting, though, and aligns with those positive forward EPS projections we discussed earlier, is that Wall Street, on the whole, does expect earnings growth for upcoming reports.
So the belief persists that the current operational gains, the route expansions, selling the resort maybe, will eventually translate into absolute profitability growth.
That seems to be the hope baked into that forward PE. It's a constant game of managing expectations versus delivering absolute performance improvement.
A tricky game to play.
And the biggest strategic move, as we mentioned earlier and really can't emphasize enough, was the sale of the Sunseeker Resort to Blackstone for $200 million in July 2025.
Yeah, that looms large over everything right now.
It's not just a financial transaction, it's a massive strategic pivot, a very public declaration almost.
Indeed. It strongly suggests a definitive refocusing on core airline operations after that diversification attempt that, by many accounts, and as that blunt source put it, was financially challenging and maybe a costly distraction.
Shedding what clearly wasn't a core competency.
Right. Underscores the hurdles they faced and signals a desire to streamline the business model. On a related note, remember we saw implied volatility for ALGT stock options surging back in June 2025.
Yeah, just before the sale was announced, right?
Exactly. It indicated options traders were expecting significant price movements, either up or down. That kind of surge often precedes major corporate announcements like this resort sale or earnings reports as traders try to position themselves for potential big shifts in the stock's trajectory. They smelled something coming.
Makes sense. Okay, let's pull back the curtain on one more aspect that gives us insight into how Allegiant actively shapes its operating environment: their lobbying activities.
Following the money in Washington.
Exactly. Allegiant Travel Company consistently engages in corporate lobbying, spending quarterly sums to influence policymakers and regulations. It's a common practice for large companies, of course, but it's always worth looking into. Helps understand a company's strategic priorities beyond just the balance sheet.
Absolutely. What are they focusing on?
They certainly are consistent in their engagement. Their lobbying efforts have predominantly focused on areas directly relevant to their business, as you'd expect: aviation, airlines, airports, transportation, and travel tourism.
Standard stuff for an airline.
Right. These have been constant areas of focus for them since at least 2011, according to the data. Makes perfect sense for an airline deeply embedded in the travel ecosystem.
But is there anything unusual or new in their lobbying?
Well, what's truly fascinating here, and a point that warrants closer examination, is the increased, much more targeted focus on taxation internal revenue code, specifically in 2024.
Taxation, they up their spending there.
Significantly. They dramatically increased their quarterly lobbying sums on tax issues, spending $100,000 in April 2024 and a substantial $200,000 in July 2024 just on tax-related lobbying.
Wow, $100K and $200K in consecutive quarters on tax. Compared to what normally?
Compared to their typical quarterly spend across all issues, which usually ranges from maybe $40,000 to $70,000. So this focus on tax represents a huge jump in spending in that specific area.
That's a massive increase. What are the broader implications of that shift? What might they be trying to influence?
Well, lobbying efforts like this indicate a company's proactive approach to shaping the regulatory and, critically here, the financial environment it operates in.
Trying to tilt the playing field.
Maybe. The increased spending specifically on taxation could signal several things. Efforts to influence tax policies directly relevant to their profitability, perhaps seeking specific tax breaks for capital investments like new aircraft.
Or trying to mitigate the impact of certain taxes on their operations. Fuel taxes, maybe? Airport fees?
Could be any number of things. It suggests they are actively working to improve their financial landscape through policy influence, viewing it as a key strategic lever to enhance their bottom line, particularly given those current profitability struggles we talked about.
So it's a company actively trying to influence the rules of the game to its advantage, especially on the cost side via taxes.
That's what the lobbying spend suggests, yes.
Yeah.